Well, here we are, folks. Welcome, 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 and good to see so many on. And hopefully the audio is back to scratch again this week. I've done some further work on the studio. I can now put up my pre-show little monocle and just get that going a little bit. And had a few people ask about the doggy cam. The answer is the doggy cams are actually up and running. So that's doggy cam number one, which is showing Luna and Meteor in their beds and completely sound asleep at the moment, having had an early lunch to keep them quiet. And if I go to the other cam, oops, I wish I hadn't done that. Let's go back. Yes, hang on a moment. There we go. If I go to the other cam, then that's also the other picture. Anyway, all good, and nice to see so many people on tonight. Just to explain that the automation is still not fully up and running in the studio, so we might have a few funny transitions, but hopefully we can sort that out before we go too far into the wherewithal. And just to explain that the doggy cams, of course, are actually remote cams, so I can actually move it around a bit and basically just play with the views. Now I want to see whether I can just do a couple of tweaks. Yeah, good. All right, so let me just cut back to my main camera and just remind you before I bring Damien in that of course this is a general conversation only. We don't provide specific financial or legal advice. This is just a general conversation. Do play nice in the chat room, please. No racial slurs, as at the 4th of July 2023. If you'd like to get my attention, ask a specific question, use @WalkTheWorld. That'll make sure I see it in my queue. I have also enabled Super Chat, and if you want to get yours to the top of the queue, that's a way of doing it, or indeed make a contribution to what we do here. And really appreciate all those who do make a contribution to the show. It really is greatly appreciated. Anyway, with that out the way, I guess the next object of the exercise should be to bring Damien in. So Damien, hello, how are you?
Hey Martin, how you going?
Yeah, I'm very good. And how are you going? Somebody said the other day that your virtual background makes you a bit look like Red Dwarf, you know?
Right, I've got to. Well, I was told from a marketing team that stop showing my what's going on behind me and show a bit of and add in a logo.
Yeah, no, that's good. It all works, and I guess the point there is that with all of these things, it's form and substance, right? I reckon the audio is the most critical thing. As long as audio is working, right? As long as you've got a reasonable picture, then it won't be too bad. But hopefully the audio is sounding good to everybody out there. We had an issue the other week when the audio gain was a bit hot, and I lost the meter, and so we had to sort that out. But yours is sounding pretty good. And look, there's so much to talk about, Damien.
And hopefully they're not logging in to see me. It's I've got a few charts I'll show a bit later, but yeah.
Yeah, I was going to say, I think it's
on YouTube, I'm sure.
Yeah, it's substance rather than form, I think, which is the critical question here. And just to explain to everybody that we are doing this show, obviously live, but encourage anybody to ask questions as we go through, and I will try to get to them as we go through. But Damien, I've got a question for you to start the show, and that is, where's this recession? I mean, earlier in the year, everyone was saying recession is coming. All of the indicators, well, not all of them, but quite a few indicators are suggesting in recession, not yet. So is it postponed, a recession postponed, or is it recession, gone away? What do you think?
Yeah. Look, I mean, all of the leading indicators are still pretty dire. Like they're basically, if you look at any of the surveys, all the expectations in terms of what people are going to be spending and all these things like that, they all look absolutely recessionary levels. Then you look at actual inflation, actual employment data, and GDP growth, and that looks all right. I mean, there are some. So Germany is in recession, um, and there's a little bit of weakness throughout Europe, but so they're starting to get the other side of the energy shocks sort of coming out of that. So there's probably a little bit of strength there. Japan looks all right. China looks very, very weak. The US looks okay. And Australia, look, the only thing that I want to say in Australia is there are some signs that are coming out in just in the last few weeks, and that are starting to say that look, are we getting there? Um, but you're right, yeah, that that the concrete signs are certainly not there, and it is something to question. Are we going to? Is there something different that's going to save us this time around?
Yes, and I think the most interesting part of this is the conversation about lags, right? So if you think back 2 or 3 years, we had this massive COVID stimulation, right? Both from the central banks around the world taking interest rates ultra low, doing quantitative easing, as well as all the government throwing money at everybody. A lot of that money is still sloshing around the system, so liquidity went very, very high and is coming down. The other point in terms of lags is that when you actually increase interest rates, of course, not everybody's equally impacted from day one. And what this means is essentially is that it takes a long time to trickle through. So, for example, in the UK, we've got 80% or more of households on a fixed mortgage rate, which means that essentially you can put their interest rate up, but they don't actually get hit until down the track. Not quite so high in Australia, but quite a lot higher than it used to be. So I think part of the discussion is it simply that the lags haven't yet worked through and we're going to actually see a lot of stuff later, or is it actually going to actually play out? And I don't know what you think about that. I see you've put a chart up, so let's put that up there as well. There you go.
Yes, and this is related. So I think to answer your question, yeah, I do think it's lags, and it's hard to tell how long it's taken before it comes through, but I do think it is it's delayed, not avoided. But at any time when you do get big delays, you do need to question what are these, how could it be different? It is getting difficult to see. I think what you're talking about there in terms of the money sloshing around, this is a measure I think from Wells Fargo that I had, that just sort of an interesting one showing this cumulative excess savings, as they call it. So all the checks got thrown at the US. They built it up to sort of over 2 trillion in sort of this excess savings, and then they've been running it down since then. And most of the investment banks have sort of a version of this, and they're all estimates, so they don't all line up that well, but the trend does. And I've seen ones that have it running out about now. This one sort of says, yeah, you've got a few more months while people eat through these savings balances. But I would highlight as well that this is an overall savings balance. It's not evenly spread around the economy. And as you said, the Australia has its own special characteristics in that our mortgages do hit a lot faster than in other countries, and so so quite potentially we're seeing that happen earlier. Another good example of that was sorry, let me go back to this is bankruptcy filings for large corporates. I think this one's looking at over $50 billion in liabilities, and this is at recessionary levels. It's back to the same heights you would have seen in 2020 and back in 2009. Having said that, there's not a lot of companies going broke. There's sort of the 4-week average. I think this is on an average weekly, sort of 8 per week. So so a few small or a few companies can throw this in and out. It can be a volatile series, but you don't see this at all in some of the consumer stats. So some of the consumer stats in the US are still very, very low. Same in Australia. While they might be half of what they run at in prior to sort of COVID. They are starting to rise quite quickly. but yeah, still a long way behind. So I guess to sum it up, large corporates, they're at recessionary stages in terms of the bankruptcies. The next tier it has sort of passed through average and is starting to sort of and it's on quite a high trajectory, and so it's sort of, I guess you'd say it was it might have been running, say, last year was running sort of 10 or 20% below average for most of last year. Now it's running 10 or 20% above average, and quite quickly. All the change has been quite sudden, sort of over the last 6 months. And so if the trend continues, then that's gonna keep higher. But consumers are still a long way behind, and that's that whole variable part that you're talking about, and saying, well, if consumers take a bit longer, then how does that sort of, what does that mean for spending patterns, and how long it takes to hit the rest of the economy?
Yeah, and just on bankruptcies, it's worth, I think, also highlighting that bankruptcies are up in Australia. And interestingly, of course, it's the building and construction sector that's leading the charge. And I was talking to an insolvency practitioner the other day who is saying to me that they have never now been busier than they currently are. So there's a lot of forward-looking bad news. And it's interesting that quite a few of those businesses are medium to small size businesses. Quite a few of them are secured against property. So it'll be very interesting to see whether, in fact, there's a spate of property sales that come through the bankruptcy processes. And this insolvency practitioner I was talking to also said, a lot of this was actually, the seeds were laid through COVID. So effectively, they had cash flow pressures. And then they had this profitless boom, particularly for the construction sector. And so those government programs that were designed to sort of save the building sector actually crushed it, particularly some of these smaller ones. And with wages for workers still rising quite fast in the construction sector, and with the demand from things like the Olympics up in Brisbane now, as well as some of the reconstruction that's still going on post the floods, there's a real question about the supply and demand for the construction sector. But the bottom line is they expect to see a lot more bad news from small medium firms in Australia over the next few months.
And then the other part of the property is that you probably call the epicenter is the commercial side. Certainly, overseas people are worried about that in terms of that's where the problem's going to be. And just in the last month, we've seen so this is just a property asking rents in Australia for retail properties, and the last two data points we can see there is July. I think must be start of July. They run this on July data and then the June data, and you can see quite a sharp downturn in it. However, interestingly, and actually, sorry, and just to take one step back, vacancies are pretty high in this retail segment. So it's interesting. They've actually, on one hand, they've been able to sort of keep getting these asking rent increases for some time now. But interestingly, when you dig into this data and have a look at the cities, it's actually all Melbourne based. And so the other cities, Adelaide's a little bit down, Brisbane a little bit down, but Perth's bounced back, and Sydney retail's all right. Hasn't really turned down. It's all been from Melbourne. And so just one more. There's just some weird data bouncing around, and that's that commercial side is one area in particular that we're watching. On not just the retail, well, so at the moment on the retail, because that's where we're sort of worried that that's where we're thinking we'll start to see some signs as the consumer starts pulling back, as all these rent or the fixed rate mortgages start to roll off over the last few months and the next few months. And then also the office side as well, and so that's where I don't think it's going to be at the moment. It's not looking like it's going to be a financial crisis type level, but it's been a while since we've had a reasonable sort of clean out in that sector in Australia, and so would it be somewhere like in 1991, maybe not as quite as extreme as that, but that type of pull back in the commercial sector, that seems to be a reasonable baseline for what we'd be expecting. So that's where we're sort of following these quite closely to try and work out what's happening within those sectors.
Yeah, and one question, of course, which comes to mind immediately when you start talking about recession is the inversion of the yield curve. So if you look at the US, the 210 is now, 110 basis points inverted, which is probably more extended than it's been for some time. And even in Australia, we've now got an inversion in the yield curve. And just to explain to everybody, so an inversion means that shorter interest rates are higher than longer term interest rates, and the bond market is therefore assuming that at some point rates are going to be driven down quite a long way, because normally you would expect long-term rates to be higher than short-term because you're locking at money for longer, there's more risk, and therefore in the normal environment long-term rates are higher. So we've got this significant inversion, and there's a big debate going on at the moment as to whether in fact this is a significant leading indicator of a potential recession later, or whether it's just so bust at the moment with all this liquidity sloshing around and everything else that really it's pretty meaningless. And a few people have said, well, just remember, it's actually not so much the inversion itself which is the signal, but it's when the inversion reverses that actually is the signal point. So there's an interesting debate going on there at the moment, and in the US this is a big debate, I think, at the moment.
And I quite like the expectations on this as well. The description of the expectations in that, certainly for some of the longer term ones, you've basically got people in two camps. There's some saying, look, this is going to be a significant downturn. We're going to have to cut rates. We're going to go back to where we were in terms of low inflation and just that constant, we haven't got enough demand to sort of push inflation higher. And then you've got another camp which is saying, no, actually things have changed. It's higher. Inflation's now embedded in the system. It's going to be too hard to get rid of it, and central banks don't have the gumption to do it, and so inflation's going to be higher in the longer term. And so if you think about prices as sort of being a reflection of both those views, I guess where I'm getting to is the people who have the negative view have even much lower expectations for those long-term bond prices priced in, and so and that's that. For me, I've sort of hit the level where I think I'm partial to the expectation that yes, we will head back to where we were and low demand and the we've sort of had this shock, sort of one-off shock, but the productivity benefits and some of the AI in particular sort of driving through a few sectors will sort of get back to that deflationary level. But on the flip side, if we see governments turn around, so if we head into recession and then we see governments turn around and say, hey, actually we threw lots of cash at the problem during the coronavirus sort of pandemic, maybe we just do the same thing again to get us out of this, then I could change my mind and say, yeah, we are going to head for higher inflation, because if I guess my take is that monetary stimulus, once you sort of get to those low levels where you just try and push interest rates down in order to try and get people to gear up and go spend more money, I think has reached close to the end of its limit in most major economies. But the idea that governments print money, go and throw it directly to consumers, and that generates inflation, that sort of rings pretty true to me. And so some of this is really a working out what you think the expectation is for government reactions if we do go into recession. Is it going to be further stimulus, or are they going to be a lot more restrained this time around?
Well, one of the big observations, Damien, is of course that as interest rates are rising as they are now, governments' debt servicing costs are going through the roof. And that's a very significant factor. Now, I know that the Treasury reported a significant increase in the surplus recently in Australia, but still a very small surplus. But that's going to go away again unless interest rates come down dramatically. And of course, other countries, for example, in the UK as well as Europe, they're paying a lot more for the government debt. So you can understand that there is a motivation amongst governments to try and get rates lower again, because of course the cost of debt is such a big impost on them. So I think that's one factor to bear in mind. The other factor, which is quite interesting, is that there was a presentation from Portugal last week where we had Jerome Powell and Lagarde and the Japanese governor, and also Andrew Bailey from the Bank of England. And they were all pretty much on the same hymn sheet saying, we've got to crush inflation, we've got to crush inflation. But what was interesting was quite a few of them had an expectation that inflation is going to come down, but then it will actually begin to come up again. And I think behind that is an observation about the base effects. So we did have some periods when inflation ran significantly high, and that put the overall number up. But we also now have, those are dropping out, but that dropout is going to disappear. So it may well be that inflation won't come down in a nice linear fashion towards the 2 to 3% target. It could actually be going up again. And in fact, the Japanese guy there specifically said he's most worried about the fact that it could well be inflation is on the uptick, not immediately, but later. If that's the case, then they can't take rates lower. So there is, I think, a double bind ahead for many economies.
Yeah, and so I mean the big issue for me is in the short term is this recessionary issue. Is that I do think a recession will kill inflation without too much of a problem. The issue will be, that the recession is going to hide what's really going on, and so will that when you kill inflation because of a recession, is there underlying dynamics of inflation sort of sitting there waiting to come out again, or and they'll return once demand returns to more normal levels, or is it, or are we headed back to where we used to be? Actually, that's probably a reasonable jumping off spot. I've got a bunch of charts I wouldn't mind running through just in terms of trying to get to the bottom of where this inflation's coming from. And I just wanted to highlight in particular food, because that's one area where it is causing significant issues and confusion, and myself included, in terms of trying to work out what's going on within that market. So I might just jump to I think I've got the this is the US inflation. I'm going to jump around a few different countries. I'll use Europe and the US and Australia. So this is just showing exactly what you spoke about, that inflation's very clearly peaked and fallen. It's probably not quite halved, but closing in on it in terms of that the PCE, which is I think the one that the Fed prefers to use. But if you break that back to core, then it doesn't look anywhere near as impressive, that fall. Like, it's very much the first chart is this sharp spike higher up to 7%, and then this dramatic drop back down to under 4%. Whereas the core inflation, which is sort of which excludes some of the food and energy costs, and it's got some other calculations in it, is peaked at 5.5 and now it's 4.5. So doesn't look anywhere near as impressive in terms of that. And so digging into the food side of it, this is the part which is, as I said, I'm bouncing around trying to work out what's going on. So, because this is the food price index that you get from the UN. And so they run, it's mainly sort of commodity prices. So more, think of it more as wholesale prices. And their charts are a little bit confusing, but the orange line here is 2022. And it's each month of the year. So to try and capture some of the seasonality. But you can see that 2022 sort of rose quite sharply to March when the Ukraine war started. And so that was sort of up, 20 odd percent. And then pretty much since then has fallen all the way back down. So actually by December, it was back to January levels. And then the red line is 2023, and it's just been consistently falling. And then you break that into the last couple of years as the chart on the right. And this is broken up by different segments of it. So vegetable oils are down, they're more than halved. Cereals are down 20, 30%. Dairy's down, that type of thing. Meat is down sort of 10%. Sugar's up, but the sugar's a pretty small component of overall prices. And I know what everyone's saying is that ain't happening where I'm shopping. That's not a reflection of what's going on at the grocery store, and it certainly isn't. if you look at, I've put up, Bloomberg runs a few. It's got French's coq au vin index and Spain's paella index, just looking at food price inflation, and that's running at sort of 15% on an annualized basis. And I'm sure most people have probably seen the images of the riots happening throughout France. Now, yes, there are social sort of sparks to that, but I don't doubt that this, food inflation running at 15% is having a significant effect as well in terms of people, not being able to get the food they want, and that we saw the last time we had sort of major food price issues on a global basis was when we saw a lot of the Arab Spring and a lot of political upheaval in a lot of developing countries. Now, the interesting thing for this time around is the developing countries' food prices are relatively low still. Like they really have not seen the same food inflation that we've seen in developed markets. So developed markets are getting these 15% price rises, but it's really not happening at the wholesale level. It's really not. Yeah, it's not happening at the wholesale level. It's happening at the retail level. And there's a whole bunch of countries now, out there with these looking at trying to set up inquiries and is it greedflation and things like that. So I just wanted to highlight, here's an example of beef. So hopefully this will make you feel a little bit better about what's happening in terms of the wholesale prices. At $4 or $5 or less than $4 a kilo for most of the early 2020s, rose to sort of between $5 and getting close to $9 a kilo, I guess, is where we are now. Whereas retail prices are sort of running closer to $30, and the margins have picked up in terms of they're up. Well, from 15 years they've doubled. They're up. Just since the pandemic, you're up sort of maybe 50% in terms of the margins that people are getting. Now, that some of that is wage rises. Some of that's the rent we spoke about, and rents have been pretty strong. Given how we spoke about the relatively high vacancy rates. So rents have been relatively strong. Packaging's was particularly high. Transport costs have been really high, but both of those have faded off again. It does seem as if there's sort of a pig in the python argument that all these costs shot up and now they've come back down again, and so you'll see the margins eventually come back, but yeah, we haven't seen that yet. And so that's part of the reason for company profits holding up, but a big part of the reason for inflation staying high as well in developed countries.
Yeah, and just let me say, Damien, there's been a lot of discussion here in the UK about the amount of price rises that particularly retailers are passing through. And if you look at, for example, petrol, the major petrol distribution channels are predominantly owned by the supermarkets, and they're up about 3%. So they haven't actually passed on the margins. And there's a big discussion about supermarket margins. And
actually, if that's 3% margins, I mean, it might not sound like much, but actually they're very thin margin businesses, those petrol ones. So that's a significant increase.
No, it is a very significant increase. And interestingly, they're talking about now a better price comparison tool to allow people to try and shop around and find the cheapest petrol. And there's a lot of
a bit like our we didn't run some of those
exactly. It's like deja vu all over again with regard to some of those things. And the other point there, Damien, is that some of the other categories of retailing, it does look as though retailers are rebuilding their margins. So it may be a combination of, as you say, the python, but it looks to me as though greedflation is something which is more than just a political spin. I mean, politics was all about blame somebody else for the inflation problem. But it does look as though there is something here, particularly when corporate profits are still doing reasonably well and, frankly, are still expected to, potentially
to keep rising,
continue to perform, which is going back to where the markets are.
Yeah, actually, and let me come back to the profits.
Mm,
So let's not, we won't lose that. Before we do, I do want to just talk wages. Now, US wages are quite high. UK wages are quite high, and so there are some issues I think in terms of those. Australian wages aren't. Like I just want to highlight that we've got all this I guess pearl clutching and these concerns about we're about to get out of control and it's going to be a wage price spiral and all these things like this in Australia. 3.7% or something like that on the wage price index is not high. Like that's well, first it's well below inflation. But as you can see on these, we ran sort of 4% inflation for a lot of those years prior to it. Um, if you think about this is just a chart I've got up here of productivity growth, of labor productivity growth, annual labor, just sort of looking at the US and Australia, just over about 100 odd years, just to sort of give you an idea from different periods. But 1 to 1.5% is pretty reasonable as an assumption for labor productivity. So if you've got labor productivity at 1 to 1.5%, and you've got 3.7% or even 4% wage growth, then you take the 4% wage growth, you knock off 1.5% of it, brings you back to 2.5%. That's what inflation is on a big picture sense. Like that's the middle of our band. Like that's where we're aiming at. I don't understand the concern about in Australia in particular about wages. It's this expectation that the RBA has that they're going to get out of control because of what we've seen elsewhere. But we're also doing. I'm sorry. The other one I wanted to show is that the real labor is we're going backwards in terms of
mm.
real incomes. Even based on the RBA's own data, they're expecting wages to go backwards and not to recover during this cycle.
Yeah, and Damien,
Um,
just on that, before we go on, Tarek Brooker did a really interesting piece of analysis where he broke out the real wages growth by different cohorts. And what's really fascinating
right.
about that is that younger households, the 20s to 30s, 30s to 40s, their real income has gone backwards at a faster rate over the last decade relative to some other cohorts. So even that sort of real labour income number distorts the distribution across the population base.
Yeah, yeah. No, Australia's had a terrible, decade or more of this just terrible wage growth. Um, then, if you look at sort of breaking it between unit profit and unit taxes and things like that, the big lines. Sorry, the big ones are the green sections, which is unit profits,
Mm.
where you're seeing all the increase in terms of inflation, and then yeah, this is some from there was a guy in the Guardian writes on this. Malik Metal Bank. Anyway, he's put out a few good ones, but sort of showing yes, wages sort of back at 2012 levels on a real basis. And if you look at the income and you look at unit labor costs, they're running below CPI. The thing that's running high is the unit profit costs. And so yeah, I think that for me, the fake concern about we've got to do this to bring wages down, and we need more people to pack themselves into houses while we have 1 million houses empty, is is a reflection that the RBA has one tool to do, which is interest rates, and that the government is the one that has lots of different tools they can use to try and solve this, but they're really not using them. And the two big ones that they've got is one of them is in energy costs, and they could have done more with energy costs. They could have done price caps. They could have looked at all these different ways of doing it, and we haven't. And we've seen massive increases in terms of the energy costs, and Australia on the east coast, not on the west coast where they do gas reservation. And so one main thing that we're seeing in that CPI is energy. The other main one is rents, and we're about to run, or running a record increase in terms of population. So, almost 500,000 people coming into the market. And actually, if you break it as well into the civilian population greater than 15, and so which sort of leads to your labour force. Your labour that's even higher than the total population, and so and they need somewhere to live, and so that's sort of pushing up rents, and so you've got the RBA in a way hamstrung in that the two of the biggest inputs into it, the energy and the rents. The government's running policies that are effectively pushing them up, and so you basically means you get a dent demand even further in order to bring these profits down. And so yeah, that's a question about how high do you need to raise interest rates in order to get people to stop spending enough that companies start saying, well, rather than keeping my sales flat but rising my prices by 10%, maybe I actually do need to start cutting my prices to otherwise I'm just going to start losing market share.
Yeah, and a couple of observations on that, Damien. The first is that's really interesting, of course. If you actually open the migration tap, it's quite difficult to get a recession defined as 2 negative quarters of GDP growth, because the top line number keeps getting bigger simply because there are more people sloshing around the country doing things, and that actually creates some potential for more momentum in the economy at a aggregate level. But if you look at GDP per capita, which is a more appropriate one, which takes account of things like productivity, I mean, that's gone backwards and it continues to go backwards. And a lot of the discussion about productivity is half-baked. It's interesting that Phil Lowe recently in front of evidence that I think one of the Senate inquirers was talking about productivity and the need for productivity growth. But productivity is shot not just here in Australia but also in a number of other countries too. The other interesting observation though with all of this is that migration number is going to have a downward force on income, because a lot of the people that are coming in are prepared to work for less, and businesses of course want that because they can actually keep a head on wages growth. So it's a really interesting observation that some of the government policies are pulling in an inflationary direction but also having a deflationary effect on wages. So I mean, it's nuts.
Yeah. So the thing they keep talking about, they're worried about this wage. We're going to get this wage price spiral. We're going to stop this wage price spiral. That's the one I'm not concerned about, because in Australia at least, because we bring so many people in that we can't get the wage growth because you've got too many people and forcing a flood of supply. And then the flip side is the things that they can't control. We're jam packing more people into them and forcing up inflation from that perspective. So yeah, I think there's the US put out a Inflation Reduction Act, which probably that overstates how much inflation reduction it's doing, but it's certainly got some goals within there to try and say we need to bring back manufacturing to the US. We need to get more infrastructure. We need to get things. We need to get rid of bottlenecks to try and so that we don't have this same type of inflation again. And there's government policy. It's genuine government manufacturing policy to try and bring down inflation. In Australia, we're basically jam packing as many people as we can into a limited space where we've got running record immigration rates. That's our policy. And we haven't got that thing about a government who's out there saying, how can we get inflation down? What are the policies we can put in place? And, I think as well, it is important to remember that these policies are very long-term policies. Like there's not too many things you can do from a supply perspective where you can say, yeah, I'm going to go and put these policies in place, and in 6 months' time we'll have sorted inflation. Most of these are sort of 5 and 10 year policies to say, okay, how do we get our ports cleared up? How do we get supply in particular areas? How do we change our manufacturing to try and keep those inflation levels down? And we're just not doing it. So yes, we won't complain too much about that. To go back to earnings.
Yeah, quick observation. Just the other thing you touched on, this gas reservation thing, right? It's now hitting households, right, with the price increases from 1 July, right? And the average is 25% down the eastern coasts. But it's not the average that's important. There are actually people who are going to be paying 50 or even 100% because of whatever deals that they were on. So there's another inflationary surge coming through, and my reading of the government support is that it's not necessarily going to touch the sides for many people who are going to see significant increases. So there's another reason why inflation may not die.
Yeah, and actually, I must, as a public service announcement, if you haven't gone out and chased the whatever states you're in, the various rebates you can get, you have to actually go and ask for them. That's part of the issue as well. Is that they haven't been put in place. I must have missed it, because I thought at the time when they were putting it on, I thought that it was going to be like a behind the bill thing where you get the rebates and so keep your prices low, but it hasn't. It's kept the prices have been pushed up, and you got to go to a website and ask for it. And I think in some states you've actually got to go and ask separately for can I have the federal government one, and then can I go have the state one as well? So they haven't made it easy, which means people won't. A lot of people just won't do it, and so I think some of they're
just on
overstating
that,
the amount of help they're giving.
Just on that, it's interesting in the UK where they had a couple of schemes, one of which was actually automatically off the bill. That was only for people who were on direct debits, which tended to be those who were actually more affluent and able to actually do it. But all of those people on prepaid meters and other forms, they had to go out and do stuff. And a lot didn't, because they didn't know what to do. It was complicated. They weren't online. They couldn't get online. So the very people that needed the help the most never got it. Yeah. And I fear that you've put your finger on exactly the same issue in Australia. I think a lot of people who need it won't get it.
Yeah. Now the other one on that gas side is that we put this gas reservation on, and we were wondering, like, why the hell we've got this $10 cap, $12 cap. $12 cap. Sorry, I've forgotten the number. Anyway, there's a cap. It was like double. It ran at like double that cap. And we're like going, what the hell's going on? Are the companies just ignoring it? Like, are they... But when you get into the fine print, actually the cap's on contracted gas, not on spot price gas. So basically, the manufacturing lobbies have got, they've been thrown sort of... probably a bone is probably the right the right thing.
It's more than the bone. It's a whole cow.
Yeah. No. Well, I guess the gas companies themselves are taking all the meat. Yeah. They're throwing the manufacturers a bone, and they're not throwing anything to the retail customers, because the retail prices can go up, and so they can run it sort of double that level. And if that's what the gas lobby wants to run them at, and given there's a handful of companies and effectively a cartel, they can, and it looks like they will just run those prices at higher levels. So one more I guess one more indication that what we're really getting on a lot of this gas is in terms of solutions is hot air. Like it's yes, we've got this great solution to put capped gas prices on, but actually it doesn't affect a whole chunk of the market. We're gonna give all this money to people to help with their gas bills, but actually you have to go and fill out all these forms on, one for your state ones, and then the different one for your federal ones, and you got to jump all these hurdles, which means people aren't going to do it. And so I think that's it's done for the press releases and the headlines more than as an actual policy to try and help bring down inflation.
Absolutely, and it's worth saying, I think, on that in particular, the press releases and things highlighted the pressure that the retailers were under, right? But there was nothing at all on those wholesalers. The wholesalers are the ones who are actually able to command global prices, and of course what we're doing is effectively still allowing them to charge domestic Australian users the marginal cost of the global price. We are the producer.
Just to redefine that. East Coast,
yes, good point.
It's not happening on the West Coast.
Yeah.
For some reason, Australia, for some reason, and I'll put it in inverted commas, that nobody can work out, Western Australia, which put on gas reservation, isn't having the problems. And so, anyway, and the saddest thing is with this is that when you look back at how little they donated to our political parties. Like, I mean, there's one thing for a political party to say, okay, we've sold ourselves out to the gas lobby, and we're gonna, we're going to let them get away with all this and let them, literally tens and hundreds of billions of dollars that they might have paid in any other country, but that they don't have to pay in Australia. It's a few $1,000,000. Like, it's just like, at least I feel, well, if they'd bought both parties, but they'd spent, $50-100 million buying the party, and they'd thrown all this, and then they'd got back, a few $1 billion in returns. But it's not. It's a few $1,000,000 they've donated to I think it's $1 million or a year-ish to both parties, and in return they're getting sort of literally tens and hundreds of billions of dollars in savings. It's just a little bit sad that if we've got government who's going to sell out to that, they didn't ask for more.
Exactly right. Now, you were going to go on to talk a bit about earnings, I think. So
earnings, yes.
Maybe we should do that.
Let me flip to some charts on that.
Yeah.
So partly the reason for the markets rising is that earnings look like they've turned, and so this is what's called 12-month forward earnings. And I've used the S&P because it's relatively a good proxy for the rest of the world as well. But what it does is it takes a little bit more. So every day that goes past, we take a little bit less of 2023 earnings and a little bit more of 2024 earnings. And so we can see that we had this big fall in terms of earnings, and then it's actually started rising again, which is the part where people are like, oh, actually earnings are all right. Maybe earnings are going to rise, and so therefore we can we can pay up for the market. It's going to be a soft landing, and we're going to make it this through. You can sort of see throughout history that this 12-month forward pretty much rises pretty consistently throughout time. And then you get some pretty sharp downturns from time to time. And that's where you get the big drawdowns in terms of markets. The issue I have with this latest rise is that it hasn't been driven by actual earnings upgrades. What it's being driven by is downgrades to near-term earnings and what I'd call quite bullish assumptions, or I'd probably even say unrealistic assumptions for next year. And it's most well illustrated by this is the earnings forecasts, the percentage return over time for 2023. So you can see that Q1 started at, like, analysts were expecting 10 to 15% growth a year ago, and then they downgraded it all the way, and it came in at sort of -3%. Same thing happened for Q2. Expectations started last year at 10%. It looks like it's going to come in closer to about -8%. And that's the quarter which we're just about to get the reporting coming out for that now. So maybe it won't be as bad as that, but I think it'll be in that ballpark. Q3 earnings have been downgraded. So they've been downgraded again from about 10% down to 0 so far. My expectation is we'll see a further fall in that. The issue is this Q4 number hasn't changed. And so that's where expectations are that it's almost 10% growth for Q4. And it's the same thing into next year. So basically what the market's telling us was, things were really bad in Q1. Things are really bad again in Q2. Q3, actually, that'll be all right. That's about the same as what it was last year. And by Q4, we're back to boom times, which is basically the opposite of what the bond market's saying. So maybe it's right. I don't think so. I think we are in for, this is, if we're seeing during this period of greedflation and people worried about companies taking too much margin and stuff like that, overall, in aggregate profits across all companies are falling at 8% levels for Q2. To expect that within effectively within 3 months from today, we'll be back to running at 10% growth rates, I think is optimistic, to say the least. And so so that prior number we saw where it's rising is basically the fact that these numbers haven't been falling for the last few months. And so because they're not falling, we basically get a little bit more of an optimistic 2024 and a little bit less of the negativity from sort of Q2 and Q3 in 2023. So yes, but time we're about to hit that period, and so I'm sure next month, by the time we talk again next month, we'll have a much better feel for what's going on in terms of profitability, particularly in
Right,
the
quick
US.
curveball for you, because one of the things, of course, that's happened in the last quarter is the rise of AI. And the rise of AI has given a huge boost to 7 or 8 companies in the US, particularly, Nvidia being a good example, with very significant expectations of massive increase in revenue. And I wonder to what extent the aggregate numbers are actually being masked by that sector of the market.
Yeah, sure. Okay, I did a lot on Nvidia. I've got a couple of posts I've sort of been holding off, so I really should publish them. So in a big picture sense, uh, let's just talk about the amount of money that gets spent on data centers, because that's where all these calculations are happening. So actually, let me just grab some data just so I'm telling you the right figures on these.
And just to say,
So
Damien, we did cover some of this last month, right, on the sort of the breakdown of AI, which, by the way, people really loved and were fascinated by where the money's going to and where it's being created from.
yeah, that's right. Because I guess what I'm thinking is it's Nvidia's jumped its profits by I think about $8 to $10 billion a year. Um, and then so data centers themselves are sort of 200 billion ish. I think they spend on capex, maybe a little bit more. But the problem with that, I think I even said, yeah. So basically, they're spending 200 billion now, and I said, okay, what happens if that goes to 500 billion really quickly? Um, it's not going to happen in 6 months, but it could maybe it takes a year or a little bit more to get there. But so I'm talking massive growth in that data center area. So that means we'd be spending 300 billion. You can sort of take most of that, well, not most of it, about 40% of that's going to go to all your like actually, you need land space for this. You need to go and buy. You need to pay commissions on those. You need to you need people to do it. You need all these extra things to it. So 40% sort of gone straight away. So now you've got call it 160, 170 billion dollars left. How much of that am I actually going to spend on equipment? And then you dig through and you go, okay, I've got to spend stuff on power. I've got to spend stuff on the networking. I've got to spend stuff on all these other, having PCs that are part of the that are non sort of AI components. And you work your way all the way back down, and you go, okay, well, of that 170 billion, maybe you can get back to about 50 or 60 billion that is going to be spent on equipment. And so then you dig back and you go, well, most of that actually looks like so if you're putting it into supercomputers, then Nvidia is going to make stacks of money because they make sort of 70-80% margins on its supercomputers. But if the flip side is they're actually going to put it into a lot of sort of standard computers, like your average sort of $10,000 server, where and just run lots of them, then Nvidia only makes sort of 20% of that. And so, depending upon how you put in those assumptions, it basically looks like the profits they've already expected and already forecast for next year basically keep into account that if the data center market went from 200 billion to 500 billion. And so, so I guess where I'm getting to with this is it's just doesn't seem big enough. Like, I mean, that yes, that's one company and it's great, and there's all these other companies that are going to benefit in similar ways, and that other, the rest of that 300 billion is going to go to all these people in terms of wages and all this other stuff like that. But as a total spend on economies that are in the trillions and tens of trillions of dollars, 300 billion is just not big enough to really move the needle. And so. So I think that AI is going to be this massive productivity gain? Yes, absolutely, I do think so, but it's going to take years and to get there, a decade or more. And the real benefit of AI will be, every company making these cost savings. It's a bit like when PCs. I think the best example I've got is when PCs were introduced or when the internet was introduced. There was just all these costs that you could get rid of, and I don't need 10 people in this department anymore. I only need 7 people. That type of, those types of gains, I think you'll get from AI. It's just that when PCs came out or the internet came out, you didn't turn around a month later and fire 3 people. it took 5 years of like, okay, actually, maybe we don't need one more person. We can get away with 9 people, and then a few years later, actually, we can get away with 8 people, and a few years later, okay, now we can get away with 7 people doing the same work. And so, I just don't think it's going to come soon enough. I think it will come eventually, but I just don't think it's going to come soon enough, and I don't think it's a 6 month. Everything will be solved in the next 6 months. And it's interesting as well. Actually, the other one that came out after I spoke to you. TSMC, which is Taiwan Semiconductor Manufacturing. So they're the ones building everything for NVIDIA, or most of the stuff for NVIDIA. NVIDIA doesn't manufacture itself; it outsources its manufacturing. So TSMC has been putting out effectively profit warnings and talking about how their revenue is going to be lower. And so you've got NVIDIA with this massive increase in sales, and the company that's making it is actually saying, yeah, that's great, we're getting all this increase in sales from there, but it's actually not enough to offset the weakness that they're seeing in other areas of the market.
Absolutely. And the whole observation here about the penetration of AI into businesses later, there is an analogy to the manufacturing sector that over 20 or 30 years robotized a whole lot of production processes and a lot of jobs disappeared. Now, of course, AI can be applied to a whole second and third universe of businesses, guessing those, legal profession, one example, financial services. There's a whole bunch of I guess my question is, well, hang on a moment, what are all the people going to do then? Right? If they're AI'd out of a job, just as the manufacturing sector was actually disappeared, I worry about this build-up of people without a purpose.
Yeah,
and I think that's a moral question.
Yes, it is, and a moral, but also a political stability question. So, and it is incumbent upon governments to come up with things for people to do in terms of helping the transitions from one sector to another. And that's arguably a lot of the rise of Donald Trump and certainly populism within markets throughout history has often been driven by these technological changes that have forced a lot of people out of employment and into others. And I do say, my comment is that especially in the media world, you hear a lot about AI and replacing jobs, and it's because when it was happening to manufacturers, it was of passing interest to journalists, of saying, oh yeah, here's an interesting story, let me write that. Whereas right now it's actually, oh no, this is my job that's going to go. this is journalists who's going to, so all of a sudden it's of much more interest to journalists, which is why I think we read about it a lot more. But the other interesting observation at the moment is, if you had have asked me 5 years ago who was going to get hit by AI, one of the bigger groups, I would have said that actually it is a lot of your blue collar workers, in particular the transport sector. And what we're seeing in terms of driverless, we're seeing driverless trains are becoming relatively ubiquitous. I think most places that are sort of starting new trains are looking at driverless. But the transport sector, as a proportion of as an employer in terms of truck drivers and Uber drivers and taxi drivers and delivery drivers everywhere, that is a massive market, and that's going to cause some real pain. So, are driverless cars here right now? No, not really. There's some interesting trials. It's taken a lot longer than most people would expect, but I do think the leaps we're seeing forward in AI are only going to help that come earlier. And a lot of these AI tools is about putting tools for artificial intelligence in the hands of people who don't need to be computer programming experts now. And so I do think that'll spark some speed changes in terms of the driverless. And so I guess where I'm getting to with this is there's a white collar problem that's happening over the next year or two. But I do think the bigger political issue will be once that turns into a blue collar problem, and in particular for drivers.
Yeah, absolutely. I think there's a whole bunch of consequences that people haven't yet thought through. And as with a lot of these things, of course, it'll be sweeping up the mess from behind rather than actually laying a path ahead, which is so often what happens with these things. So, your take then is that the earnings expectations are still probably too positive relative to reality. And the chances are that means that the stock markets are currently somewhat overvalued. And of course, they've moved up dramatically from end of last year, and last October was the low. We've gone through bull markets now in recent times. I guess the question is then, well, where is the true value, the fair value of those markets relative to where they are? And I assume you have to go granular and look at individual sectors and individual stocks, because the aggregate, of course, is a sum of all the parts.
Yeah, well, look, I mean, it is the aggregate. It's a sum. You're right in terms of it's a sum of all the parts. It does tend to move up in a rising tide lifts all boats. I think they, is a relatively accurate analogy for the stock market as well, in terms of some sectors which are exposed to those, and so particularly the big tech stocks. Yeah, they ran up a lot more than other ones, but we did see that the rally start to broaden out and really start to affect a lot more stocks. Pricing wise, we are really looking at, we're in the I haven't got exactly the number, but we're getting close to the 90th percentile in terms of how expensive the market has been versus its own history. So so that's sort of like going, well, yeah, okay, but the market does need to be in the top 10% sometime. But the other times it's been in the top 10%, there's been this real growth story. So the other main times it's been in there over the last sort of 25, 30 years, we're talking about the tech boom, where markets were priced higher than what they are now, maybe 10% more expensive than what they are now. But there was this story about earnings growth behind it. Just after the pandemic, markets were priced at similar levels to where they are now, or even higher. But again, there was this growth story about, profits are low, but there's all this stimulus got spent, earnings are going to come flying out of the pandemic, and I just can't see where that's coming from now, unless there's the argument that no, we are going to, central banks are going to keep raising rates, wages are going to get smashed, consumers are going to get smashed, but companies are going to manage to keep their profits high and grow their profits into that environment. That's effectively what markets are sort of telling us, and so I'm having trouble with that as a concept. I think you need to come up with from here. You need to, if you're going to buy markets today, so the top 10% of all valuations, you need to come up with a growth story behind it. It might be, your growth story might be AI. If you think AI is going to come out, and that's going to affect productivity in the next year or 2 years, rather than taking 5 or 10 years to sort of play out. And if you don't think that central banks are going to cause recessions, if you think that they're going to reach the current levels, they'll just fade off, and we'll get this I guess a soft landing boosted by an AI boom that's going to boost profits, then I think that's your best reason to be buying right now. I find that outcome unlikely. It might happen, but I find it unlikely. I think what's more likely to happen is what we're talking about, these long and variable lags, that central banks will have done too much, and that when we start seeing these lags and we start seeing bankruptcies rise, we start seeing people lose their jobs, that then flows into demand. Then companies start to cut their prices, because if you try to raise your price by 10% as everyone's losing their job, you find everyone starts flipping to a lower price competitor, and that spirals on the other way.
Yeah, and it's also,
and actually, and sorry, just on the, I think we're already starting from, I think profits forecast for next year of 10% are already starting from 10% too high. So
As they-
I think
as they do-
that's
as
got
they
to come
do.
out first before you even talk about any negatives.
Yeah, and that's because, of course, they tend to start from a sort of a stake in the ground 10%, and they move from there, right? Rather than actually zero base from this year. That's been traditionally what happens. But I guess the question then is that if the stock markets look as though they're close to full value, and they're probably silly value, there are other asset classes, I'm thinking bonds here, for example, that are actually now offering returns which are, well, actually pretty stunning, relative to history. So is there a question then about rebalancing between stocks and other asset classes in the current environment?
Yeah,
and
absolutely.
And how do you think about that in the context of, future uncertainties and potentially lower interest rates?
Yeah. So if you think about it as if you think about what stocks are giving you as an earnings yield, so basically I'm flipping a PE upside down and saying, well, what am I making in terms of, I pay for a stock, how much do I get back in terms of the earnings? And so at the moment it's if I exclude banks and resources because of some and just look at that sort of larger industrial part of the market, you're getting a sub 5% yield. So you're getting now that in theory over a longer period of time will grow, and that's where the benefit of equities is you go, okay, well, usually if I can buy equities on a traditionally you'll buy them on a 6 or a 7% earnings yield, and that's going to grow at inflation or above inflation over the time. And so I can look at that and say, yeah, okay, that sounds like a good deal. I'll take 6 or 7% now as an earnings yield growing at inflation rather than locking myself into a bond at say 3 or 4%. And so, yeah, that gives me my return over the longer term. Right now, what we're talking about is bonds. Well, in the US, you can get 5%, but you're talking bonds in the sort of shorter term bonds, sort of high fours, longer term bonds, lower fours percents, and you're getting earnings yields in the market of basically that same earnings. And if you actually looked at real earnings yield, what did they earn? What did companies earn last year? Well, now you're talking about, maybe it's back to below 4% in terms of the earnings yield you're getting. And so, you can get if you can get a higher return on government bonds than what you can get in terms of earnings on effectively what I'm telling you, I think are inflated earnings levels, then it starts the risk return measure starts to look more attractive. Keep in mind that in any time when you're buying equities or stocks, you're basically the price you buy it at is important. If you're there's a reasonable argument just to be averaging in over a longer period of time and keeping yourself some exposure, and I'd encourage that because unexpected things can happen. But in a big picture sense, when returns are really low, earnings when valuations are really high, you need to have a big spurt of earnings to justify that. And that's where we are today. I don't think it's going to get there. I think it's the opposite that's going to happen, but I might be wrong. So, if you want to invest now, that's what you need to be able to see that, yes, I'm buying now on really expensive multiples, but I know why, because I'm expecting this massive growth to come through. And then otherwise you say, no, look, I'll have some equities and certainly keep an exposure. I'll load up more in bonds, and then as that risk return relationship flips back around, that's when I'll start buying more equities and have fewer bonds. And so that's sort of big picture what we're trying to do in terms of our asset allocation, and what I'd recommend anyone who is going to be more active on the asset allocation to try and do.
Yeah, and it's interesting because, of course, there's the old theory 60-40 is the way to go, right? But I would agree with you that a more optimal mix will vary over time because of the different cyclical movements, and quite often, I don't know what you think, but I think that the bonds tend to be a better predictor of what's going to happen rather than the markets. The stock markets generally, to my mind, seem to be overly optimistic and always looking for the next big thing. The bond markets tend to probably give you better signals, but of course they don't always get it right either.
No, that's right. The bond markets are always trying to work out what can go wrong. The stock markets are always trying to work out what can go right. But I do think as well there is a liquidity issue and within stocks sometimes where you go when there's lots of sort of money floating around and lots of easy money floating around, then it does tend to end up in stocks. The question right now is saying, That when the other thing from from a technical point of view in terms of why could stocks rally from here even further is because most fundamental places that invest in terms of fundamentals and looking at value and growth like ourselves are underweight equities. And so, and as the markets have been rallied, some people have been feeling the urge to I'm not quite sure why I've just got to keep adding more money. If you look at the programmatic traders, they tend to be fully invested at the moment and even over leveraged in terms of gearing. And so that's an area of the market though that can change really quickly. So the fundamental side tends not to change quickly. You tend to see if it's going to keep rallying, it'll be this grind higher where people just start giving up and going, okay, I've been underweight equities, I got it wrong. I don't know what's going on. I'm just going to start buying, or I'll reduce my underweights, and that's what's going to push the market up that next leg. The flip side is if we start seeing these earnings downgrades start to come and some of the negatives do flip around, the traders which are overweight at the moment, they will go quickly they're not the types of people who will wait and say, oh yeah, okay, I'll do a little bit this month, and I'll do a little bit next month, and if it keeps happening, I'll add a bit more and add a bit more. They're the ones who are basically saying, well, markets just fell 2%. I'm going to take some off the table. Actually, they fell another 2%. Now I'm going to halve my weights. That's actually caused the markets to drop another 5 or 10%. Now I'm going to take even more off the table. They will react over a course of days or at most weeks when they do flip.
Absolutely. Well, I think that keeping a watching brief is pretty important at the moment. Now, Jason, and Jason, thanks very much for the super chat there. Really appreciate that. Ask this question: do you both think AI will replace fund managers, financial advisors, and accountants in the next 5 years? Discuss.
Yes, yeah, absolutely. Not all of them. I don't think it'll replace all of them, but I think of those people you're talking about, yes, I think they're a good cause for worrying about certainly the lower level jobs within those. So let's take fund managers or accountants or lawyers. I think there's parts where it's saying, so let me take some of the boring parts of being a fund manager is writing your documentation about why you feel strongly that you shouldn't lose people's money, and go and write policy documents about all the various things that are happening. Now, they're the types of things that you would give to a more junior person, say, go and write me up that policy, and then you'll get it back and you go, yeah, okay, you've got it 80% right, let me go and fix the 20%, and there we go, that's right, I'll put it up. That's the type of thing that ChatGPT is very good at doing. It's similar in accountants in terms of being able to process data and go and run your eyes over these numbers and find where the problems are. That's the type of thing AI is good at finding those types of problems. Lawyers, the same type of stuff. Obviously there was a high profile version that came out recently where somebody just relied on ChatGPT and it just made stuff up. But I don't doubt that there will be, there are plugins you can add over the top and things like that to actually go, no, actually, as part of the settings within, the AI is don't make up precedents. You actually have to use real precedents, and things like that. And the part for that as a lawyer being able to go and write up go write me a letter of demand and put in these 5 bullet points. They would ordinarily give it to their assistant. Now they can give it to ChatGPT, bring it back. Again, 89% of it's right, and clean up the rest. So yeah, I do think that's coming relatively quickly. I don't think you'll quite see the job losses in an imminent. I guess it's that issue. I guess what I'm saying is that I think it's the part where if you're a lawyer with 3 or 4 different associates who you use, you start using ChatGPT, and then you realize maybe one of those associates isn't as necessary. Do I fire them tomorrow, or do I wait for 6 months and then then maybe a year later I'll fire another one, and so it's a process. It's not I need to hit my this quarter's numbers. I'm gonna fire 2 of my staff tomorrow.
And I'll just add to that. Jason, again, thanks for the super chat. It seems to me that 90% of what fund managers and what financial advisors do is actually relatively formulaic and, driven by data, possibly, and therefore absolutely very much a target for AI. I think there is still, though, the sort of the small, expert element, which is actually probably not going to be able to be formulated in the same way, because of course the AI, in a generative situation, looks at what's out there and then tries to sort of read the tea leaves from that. But sometimes that doesn't work. Give you an example. I mean, I've been working with an AI firm with regard to my data set. And we've been trying a few experiments to see what information we can actually pull out from the data set. And I reckon 60 to 70% of what I'm seeing is what I already see, right? But there isn't anything yet that's come through to actually highlight new connections that I hadn't seen. So I'm still ahead of the AI in terms of being able to see stuff that's driving my data set relative to what the logic tells you from what's happened previously. So I still think there's a space for expertise. Maybe I'm over optimistic, but I'm holding on to that, Damien.
Yeah, but I think though as well, like for most of this stuff, it is about making the more senior the more senior employees more productive. And I guess I take that the same as the introduction of the internet, the same as the introduction of the PC. If you went back to a company, accountants, 40 years ago, 50 years ago, before the introduction of the PC, you had a whole bunch of people sitting there, most senior person doing the policies and the thoughts and then the overall strategy for it, and then a bunch of people sitting there adding up numbers. And then you went, okay, now we've got PCs. Actually, I don't need a bunch of those people, but you still need that senior person to be able to do it. And that's, I guess, where financial planning, most financial planners use what's called paraplanners, where there is an incredible amount of documentation that needs to be done. The financial planner will take the information, talk to the client, get the bullet points, give it to the paraplanner to go away and do all the work. That's the type of thing where that'll be much more automated, and you still have the financial planner doing that overall oversight, but the sort of more of the nitty gritty and more of the detail and the documentation and compliance stuff will be a lot of that more of that will be automated and a lot simpler for them.
Absolutely, I agree with that, and I think the story will be watch this space. Now, in the last few moments, I just want to come back to the RBA decision, which of course was out today. And just to be clear, if you didn't follow it, they basically said they were going to hold the cash rate unchanged at 4.1%. I mean, if you read through what they said, they're still saying the same sort of things. Interest rates have increased substantially. There's some uncertainty about the economic outlook. Inflation has passed its peak, but as we've discussed, there may be some reasons why inflation won't continue to go down. Growth in the Australian economy has slowed, and there are still labour shortages. Wages are pretty strong. The forced participation is pretty strong, and they remain alert to the risks for the ongoing inflation could lead to both prices and wages growth, and therefore it's important that people don't actually think about wages growth without productivity, etc., etc., etc. And some further tightening of monetary policy may be required to ensure that inflation returns to target. So, they've basically not said a lot, in my view. Damien, from your perspective, anything there that stood out, or was this pretty much as expected? And they haven't closed the door on future rate hikes, and Lowe's previously said rates will probably go higher. The markets are still expecting them. But CBA got it right. The other three big banks got it wrong.
Yeah, look, I think there's potentially something in the idea that 2 months ago we had an inflation read that was very strong, and potentially, these inflation numbers are estimates. Like there's bands around it, and you can capture bits of data that make it look stronger than what it may have actually been. So maybe that was what drove that the rate hike. In terms of that, was like, actually we've got this really strong inflation one. We better add one more rate hike. We had quite a weak one, certainly at the headline level. It's not weak in relative to the whole history, but it sort of fell significantly on the month before it. Now, is that because the month before was maybe overstated, or is that because the most recent read was understated? So I think if you got another quite strong read, I think that might lead the RBA to do another one. We're obviously pretty close to the top. I do think inflation is going to come back quite quickly, and I think that I'm seeing a number of signs out there, whether it just falls in consumer confidence, falls in credit card spending, increases in bankruptcies, a number of things that just certainly over the last few weeks, that decrease in rents we saw in Melbourne. There's a number of those which are saying, look, something's starting to go on now, and it would make sense why, in terms of it being that we saw some of the biggest numbers of people converting from fixed mortgages of 2% up to more variable mortgages of whatever they're paying, 5 or 6%, 7% sometimes, is coming through right now. So that makes sense. And so I guess if we go through another 2 months and we haven't seen some significant falls and we're seeing earnings numbers holding up, then I think I need to start questioning some of my core, assumptions behind this. But for the moment, I'm treating this as a delayed rather than as a delayed crisis rather than an avoided crisis.
Yeah, and it's worth saying, of course, that the monthly inflation target, which came out just the other day, the data doesn't cover the full gamut of inflation metrics. So by giving it an extra month, they actually will get a quarterly anchor rather than a slightly warped monthly one, and that may be helpful. Plus, they'll also see a little bit more in terms of what's happening with wages growth and those sorts of things. And I guess also they'll start to see the impact of some of the energy prices coming through as well. Because I think that, like I said earlier on, my expectation is we are going to see another spike up in inflation because the base effects will disappear in terms of the positive relief, and you're going to see new negative prices coming through. And whilst fuel might be lower than it was previously, it's being offset by higher food prices and power prices. So rent well. Yeah, good. I'm glad you mentioned rent, because rent's the one I've been watching. And in my surveys, the most recent rental stress numbers have gone through the roof, simply because a lot of people have been confronted now with considerable rises in their rents. So whilst the monthly number as reported in the ABS is a bit benign, the true impact now is flowing through, and I think you and I both expected that to occur. So I think the higher rates are still coming.
And that's it's now a race between I guess when will we start to genuinely see the economy weaken versus some of these inflation numbers, because and that's I guess where policy error seems to be likely insofar as I think if they're raising rates into the face of let's say we're looking 2 or 3 months down the track and we've seen higher rents because of the extreme amount of population growth we've got, higher energy prices because of decisions that were made in terms of the government there, and what was the other one we had there? 3 things, and so we're seeing higher prices from those, but the rest of it is starting to weaken, and unemployment starting to spike up, insolvency starting to rise, earnings starting to weaken, all that type of stuff. I think that's where that would be the danger, where I'm seeing that they're going to drive us into a lot deeper recession, because I think a lot of those measures will turn at some point, but they're going to be delayed relative to some of the faster moving data.
Right, and just on the recession story, coming back around, one other thing, China, we should just briefly touch on before we close. China, of course, is not performing as people expected. They are talking about more stimulus in China, and of course they're worried about the 20% unemployment amongst younger workers in China, and maybe there's going to be therefore a different strategy that China actually runs with this time, which may not be so reliant on importing more raw materials from Australia, which again suggests to me that there is another external factor which could also have a depressive effect on the momentum in the economy here locally as well. And if you look at the most recent statistics, sure, there was a little bit of a kicker in terms of GDP, but under the hood, if you look carefully, there were some early leading indicators of negativity there too. So another reason why recession is probably not off the table.
Yeah, so the big factor for that for Australia is really the construction, housing construction. That's for me. That's where most of the iron ore goes. Most of the other commodities we're exporting are all exposed to this massive boom we've seen in terms of Chinese housing construction. Now, new housing starts are down more than 50% in terms of China. They're still about double the levels you would see in a similarly sized economy. China also has horrible demographics. So I guess what I'm saying is earnings are down. So property starts are down 50%. They could fall another 50%, and you'd be back to another level where you wouldn't be concerned given the demographics of China. So in the past, what China has been guilty of is when they slow down too quickly, they throw all this money at the property development sector and they get out the housing construction and off they go again. There's always I think Pavlov's dogs in the equity markets have been conditioned to hear Chinese stimulus, go and buy iron ore, and we've seen the iron ore price jump sort of 30% in the last couple of months on the back of, I guess, expectation that that's what they're going to do. My reading of, I guess, in everything I've looked at, I can't see anything that suggests they're going to try and get that housing construction boom going again. To me, it's all about saying more debt for consumers so that they can afford to buy these houses, the houses that have already been built. More debt for developers so they can finish the houses they've already done. They're already under construction. I haven't seen anything that sort of suggests they're going to try and get that boom going again. To the contrary, it's more about saying where else can they spend money and things like semiconductors and the energy transition and places like that. Where can they throw money that they think will actually be of more use to China? And so, if there's a question about, are you going to take, a couple of percent of GDP and throw it into building more apartments, or are you going to take a couple of percent of GDP and throw it into building more semiconductor factories and more power lines and green power? I'd be saying it's going to end up in that second part, and that seems to be the case to date. But the market hasn't reacted. Well, certainly commodity prices have reacted as if the announcements that come out are going to have more housing stimulus, and so I think they're setting themselves up for some disappointment.
Yeah, absolutely. I've been watching this quite closely, and I tend to concur that things are not going to play out the way that the markets are expecting at the moment. Another reason why a little bit of caution ahead is probably appropriate. Well, Damien, we're coming towards the end of this conversation. I really enjoyed it. Thank you very much for your time today. Any last closing thoughts? And also, I guess, to underscore what Nucleus Wealth is up to at the moment?
Yeah, so I should. Sam is. I should have got Sam's stuff. Sam's running a brokerage free promotion on at the moment. So we've launched ourselves on a different platform called Interactive Brokers, or an additional platform. We have a number of platforms where we're on, where you can buy our portfolios. And Interactive Brokers has got a lot lower fees than some of the others. And so Sam's sort of doing an introduction for that, and you can get that from nucleuswealth.com. Just register your email address, and he'll send you out more details on it. So there's got some promotional offers there to try and encourage people to start averaging in and have a chat to him about setting a policy, setting your goals up, and how you plan to take advantage. Because I think partly for these, if you are of the view that we are, that that there will be a market pullback and there'll be opportunities, then sort of sitting back and saying, oh yeah, I'll get to it when I get to it, often means you'll miss it. Whereas if you sort of set a plan to say, okay, actually let me set up the accounts, let me start getting, maybe even start dripping some in to get things started, and then as markets fall, you can throw more money into into it and take advantage of lower prices at that point.
Yeah, absolutely. Chances are there will be lower prices at some point. The question is when. That's always the big question, right? And there are people who've been calling the the fall ahead, and it keeps not happening quite the way that people expect. But there you go. Markets are fickle, and markets, of course, are caught in a whole bunch of political and economic cross currents. So it's always hard to call.
Yes, and I do think one of the issues, when you're make a forecast, it's they say you should never give a time and a level. I do want to say, I do think the next 2 months on the earnings front, I've had this thesis that we are going to see some significant weakening in terms of fourth quarter numbers and 2024 numbers. If we don't start seeing that over the next month or 2 months as we see this quarterly reporting season come through, then I'll need to reassess. So next quarter, next month we'll be back, and I think with certainly some interesting numbers coming out of the US reporting season to talk about.
Yeah, well, I look forward to that. I always look forward to these because we get into quite deep and important issues, I think, and for me that's a really important part of what we do here. So Damien, thank you very much. I appreciate that. And just before I close the show, a couple of little things to do. Firstly, you might be interested just to see, this is the current studio setup. So we've got Damien coming in over there on the Zoom, and then going into my switcher. The switcher's over there, which is the multi-view. I've got my camera here now, other things on the other computer working over there. So that's sort of beginning to take some shape. And of course, we've got the doggy cam. So Luna and Meteor, they've been sitting there most of the time. I think it's quite close to the end of the show. They look to me as though they're getting to the point where they would quite like to go and have a bit of a walk. So it's probably good timing. But Damien, thank you very much for spending your time with us today. Really appreciate it, as always. We'll put the links and things below, the Walk the World Fund and Nucleus Wealth. Very important time, I think, to be a little bit careful about where the markets are going and not get swept up by the ultra enthusiasm that we're seeing in some sectors of the market. Just remember that the markets are higher, but at the moment on a very narrow base.
Absolutely. Yes. Well, let's talk about it more next month.
Look forward to that. Thank you very much, Damien. And just to say that next week we're going to have a discussion about crypto and how that plays into this thing. So keep an eye for that. Thank you very much for spending time with us this evening. Appreciate the super chat and also all your questions and comments. And hopefully I'll continue to build up the studio so that I can bring in a few other extra little bits and pieces. But things I think are beginning to get to the point where I'm actually quite happy with how things are running. So thank you very much. Have a good evening. Keep a watch of the other shows. We'll be making more shows over the next few days. Of course, Tarek is going to talk to me hopefully on Friday, and I'll be back next Tuesday. This is Martin North from Digital Finance Analytics, signing off. Cheerio.